Welcome to this session dedicated to a crucial moment in the life of every company, the end of the financial year. This period isn't simply a deadline, but represents the conclusion of an entire cycle of economic activity. At the same time, the end of the year marks the beginning of preparations for the new accounting cycle. It's a bridge between the company's past and future, crucial for its management and evaluation. This period is characterized by two distinct but interconnected phases: the adjustment and subsequent closing of the budget. A thorough understanding of these phases is essential for students, professionals, entrepreneurs, and accountants. It allows for a clear and accurate view of the company's situation. The first phase, the adjustment, is a process of rectifying and integrating accounting records. This is not a simple verification, but rather an adjustment process. The primary objective of the adjustment is to ensure that the financial statements accurately reflect the company's financial position. This means attributing expenses and revenues to the relevant financial year. Furthermore, the adjustment aims to faithfully represent the financial situation. It ensures that balance sheet items are correctly valued and allocated. The need for these operations arises because some financial transactions are not recorded immediately. Others, however, are estimated throughout the year and require a final review. The ultimate goal is to correct any accounting inaccuracies. This includes updating values and entering transactions that have not yet been posted. The guiding principle for all adjustments is compliance with the accrual principle. This principle is central to corporate accounting. It requires costs to be allocated to the financial year to which they relate, regardless of the time of payment. Similarly, revenues must be allocated to the financial year in which they are accrued. This principle emphasizes the timing of cash flows. What matters is the economic maturation of the event, not its financial manifestation. Let's now delve into the details of the main adjustment operations. These are essential for correctly preparing the financial statements. Let's start with adjustments for accrued income and deferrals. These accounting tools are essential for complying with the accrual principle. Accrued expenses represent costs or revenues that have already accrued in the current financial year. However, their settlement, i.e., payment or collection, will occur in a future financial year. A classic example of an accrued expense is the interest accrued on a mortgage. Although the payment occurs after the end of the year, the portion of interest relating to the current financial year must be accounted for. Prepaid expenses, on the other hand, are expenses or revenues that have already been paid in the current financial year. Their economic relevance, however, extends to future financial years. Consider rent paid in advance for a period that includes the following year. The portion of the rent related to the next year must be reversed from the current financial year. Another crucial operation is depreciation. This accounting process distributes the cost of capital goods over their useful life. Assets such as machinery, real estate, or equipment lose value over time due to wear and tear or obsolescence. Depreciation reflects this wear and tear. The goal is to allocate a portion of the cost of these goods to each financial year. This reflects the actual consumption of the good in the reporting period. Depreciation is a non-cash expense that impacts the bottom line. It is essential for a correct representation of a company's assets. Impairment of receivables is a prudential procedure. It involves estimating the loss in value of trade receivables. This loss may be due to collection uncertainty. Not all receivables owed to the company are fully guaranteed. A provision for doubtful accounts is established to cover these potential losses. This ensures that receivables are recorded in the balance sheet at their estimated realizable value. It's a prudent measure that prevents overestimating a company's assets. It contributes to a more realistic representation of the financial situation. Finally, inventory adjustments are essential. They concern the valuation of closing inventory. Closing inventories represent the goods, raw materials, semi-finished goods, or finished products still available at the end of the financial year. Their value must be precisely determined. There are several valuation methods, such as weighted average cost or FIFO. The choice of method affects the value of inventory and the cost of goods sold. Accurate inventory valuation is vital. It directly impacts the company's income statement and balance sheet. Once all the adjustments have been completed, the financial statement closing phase begins. This is the time to prepare the final accounting documents. The primary objective of the closing is to provide a true and fair view. This view must address the company's financial situation. It must also clearly illustrate the financial position, including a list of assets and liabilities. Finally, the balance sheet closing must outline the financial position. This shows the company's ability to generate and utilize cash flow. The financial statement is made up of several key documents. Each offers a unique perspective on the company. The balance sheet is one of the key documents. It represents the company's financial position at a given point in time. It shows assets or what the company owns. These include tangible and intangible assets and accounts receivable. At the same time, it lists liabilities, that is, what the company owes. These include debts to banks, suppliers, and other obligations. The difference between assets and liabilities represents equity. This is the residual value of the company for its owners. The income statement, on the other hand, shows the financial results of the financial year. It's a snapshot of the company's performance over a period of time. It includes all revenue generated from operating and non operating activities. Likewise, it lists all costs incurred by the company. The difference between revenue and expenses determines the profit or loss for the year. This is a key indicator of company profitability. The income statement is essential for evaluating management efficiency and effectiveness. It provides vital information on a company's ability to generate profits. The notes to the financial statements are descriptive and analytical documents. They provide additional and detailed information that is not immediately apparent in other financial statements. Explain the data presented in the balance sheet and income statement, detail the accounting choices adopted, and the valuation criteria. It provides a more comprehensive overview of the company and its policies. It is essential for a full understanding of the financial statements. The notes to the financial statements are crucial for transparency. They allow stakeholders to correctly interpret the numerical data. The process of adjusting and closing the financial statements is complex. It requires precision, expertise, and a thorough understanding of accounting principles. The final financial statements are crucial for evaluating the company by many stakeholders, including shareholders who assess its profitability and solidity. It's equally important for creditors who analyze their ability to repay debts. Suppliers and other stakeholders also use it to inform their decisions. The budget is an essential tool for future strategic planning. It provides historical data on which to base projections and objectives. Finally, it is an indispensable tool for company management control. It allows you to monitor performance and identify areas for improvement. In short, the end of the financial year isn't just a formality. It's a time for reflection, analysis, and preparation. An accurate and transparent financial statement is the basis for informed decisions. It's the key to the sustainability and long-term success of any business.